Okay, well, we've talked a lot about value, or you've talked a lot about valuation, or you've mentioned it several times, because as you mentioned, it's kind of your number one defense is keep your valuation up. Number one thing to be ready for in terms of an unsolicited offer is to know your value.
Right.
So when you're looking at valuing a potential takeover, or when you're consulting on a firm as to their value, what kinds of tools do you use in terms of like price earnings, multiple enterprise value, EBITDA, discounted cash flows? What kinds of things do you use in terms of trying to determine what you think is the intrinsic value of the firm?
Sure. Yeah, and just to put that into context, the exercise really is to compare the trading value with the intrinsic value of the firm and assess that gap. And the larger, if your trading value is well below your intrinsic value, then that increases your vulnerability.
Right.
So in terms of determining the intrinsic value of the firm, we use a number of tools, and it's really not one ever at the exclusion of another.
Yep.
It is, and I hate when people say it, but I'm going to say it anyway, it is art and science.
Yep.
There's a lot of judgment that goes into the weighting of the various methodologies, and it often depends on the quality of the information you're working with.
Right.
And so what we rely on generally are trading comparables, which give you not an on-block value. They don't give you the control premium. So what you have there is the value of a minority share in the company, because that's just the price at the latest quote, right? So you have to notionally at least think about what a control premium would look like on top of that trading value.
Correct.
Because you need a price that's high enough to clear the market for the supply of the shares in that particular company. So we look at trading value, we look at precedent transactions analysis, and there what we look at is we look at control premiums, but that in of itself is sort of a useful benchmark, but it doesn't measure intrinsic value. It just gives you a bit of a sense of what the market expects in terms of a premium related to prior history. So, if you're offering intrinsic value, but it's at a discount to the trading value, you're never going to clear the market with that offer, and you may as well just pack your bags and go home. But we also look at, in terms of the precedent transactions, we look at multiples. So we'll look at multiples, and it depends on the industry. It depends on how capital intensive the industry and what the rules of thumb are for that industry. But generally speaking, we're looking at some sort of an enterprise value to EBITDA, an enterprise value to EBIT. We'll look sometimes at enterprise value to revenue as well. And if we're looking at resource industries, we might look at an enterprise value to a production rate, to unit production, or to unit reserves, or and you see that in both energy and the mining sectors. So there are various bespoke industry ratios that are applied there as well.
Right.
So that's trading valuation, precedent transactions, and discounted cash flow would be the other one, or an NAV analysis, and that's a combination of things. That might mean, for example, if you're a mining company, what are the projected cash flows from producing that mine to depletion and then right through the restoration. Same thing with the energy business. What are the costs of depleting those reserves and then abandoning the wells? What's the NPV of the entire portfolio of projects, right? So you may have a DCF that does sort of a blowdown or a depletion analysis where there's no capital investment or minimal capital investment and no new reserves, and then you might do a DCF where there's ongoing investment and growth, which requires a whole lot more assumptions. That's on the resource side. If you're talking about a general manufacturing business, you really are building your projected financial statements and looking at the unlevered free cash flow. And in that case, the issue with DCF, it really is sort of the gold standard in terms of theoretical valuation. The problem is that you have to make assumptions about what the future looks like. And it's very difficult, for example, even just to calculate a reasonable weighted average cost of capital, let alone to project what the company's going to do over the next 5 years, because the future is inherently uncertain unless you're talking about an infrastructure business or utility or something. There's usually a whole lot of risk or a wide range of outcomes in the forecast. And that's why when we do DCF analysis, we really have to do a lot of scenario analysis. Not only sensitivity analysis, but scenario analysis. So it can get pretty elaborate. And the issue that you get with DCFs is when you start to model a complete range of outcomes that you get really wide value ranges, and you kind of say, okay, so we're talking about an $80 stock, and the DCF will tell you the value is somewhere between $50 and $150, and because it just depends. It depends on what the company's going to do.
Discount rate, growth and cash
Yeah,
flows,
right.
all of these different things is very sensitive to.
Very, very
But
sensitive.
that's why it's important to use a variety of approaches.
We need to
right?
use all three, and they have to kind of check and balance with each other
Right.
a little bit. And with the precedent transactions, that sounds great, except from they're always dated. So if I'm looking at a precedent transaction from 5 years ago, well, 5 years ago, where was the Dow? 5 years ago, where was the U.S. Treasury rate? We might have been a completely different environment when that older precedent traded. So
Right.
there are lots of inherent trade-offs between those different methodologies.
And actually, there's different phases in M&A activity. Sometimes you'll have lots of recent precedents, and other periods you'll have dried up periods.
That's exactly right. Yeah.
And you'll be looking at very stale data.
Very, very old data, yeah. Or if you define your precedents too narrowly,
Yeah.
if you're saying I'm looking for a cat food manufacturer in the southern U.S. South, guess what? You aren't going to see a lot of precedents.
Yeah.
Maybe you got to broaden it out to pet food in general in North America. But even then, you might only have 6 transactions in the last 10 years. So if you broaden it further, now you're going to get into pet toys, and so you have to apply. You have to sort of go a little bit further afield sometimes to generate a decent sample of precedents. And then, of course, you have some precedents that are really useful and instructive, and others that are a bit more of a stretch. And so you got to apply your appropriate weighting to the weaker precedents versus the stronger ones.
Now, just to finish off on the valuation topic, so there's all this variety of approaches, and they're fairly quantitative, although they all require some judgment, as you pointed out, and as we know, I guess. What are some of the other non-quantitative things or so-called qualitative issues that you consider in terms of maybe in terms of valuation, and also in terms of if you think this takeover makes sense?
Yeah, no, that's a great question. I mean, a lot of the calculation work, a lot of the math we do around valuation is really looking at theoretical valuation. The qualitative stuff really ultimately is how much is this worth in someone else's hands?
Right.
Company A, how much is this company worth in Company A's hands? What kind of synergies can they do with this? And as opposed to Company B. Company B might get very different kind of synergies and might be worth less in that other company's hands. So the qualitative work really comes into when we go beyond just doing the math and we say, what is the field of bidders? And how active is this going to be? Because I might have a DCF that says my stock's worth $90, but if nobody wants to buy, then guess what? I'm never going to sell.
$90, yeah.
So a lot of that qualitative stuff comes around. Where are the buyers right now? Are all the buyers in financial distress? It looks as though there's lots of theoretical value to be had, but if they're all busy dealing with their internal issues, they're never going to show up and pay. Are the financing markets open?
Yeah.
Is this transaction going to be too dilutive to their EPS, and are the shareholders never going to accept it?
Right.
So we have all these various factors, the qualitative factors, that are outside of the company. So that would be certainly one thing. The other one is market conditions, just looking at general market conditions, and then just assessing risk around the cash flows, risk around the fundamentals around the company.
Very interesting, Paris. I just thought maybe if you could run us through your involvement in, you used the example of the Suncor PetroCan M&A before, so if you could just kind of give us a quick run through of your involvement in that transaction.
Sure. So that happened we really started with that, I think it was in late 2008, when we started working with Petro-Canada board, and we also knew Suncor very well, and the two companies had been they had been in discussions many times over the last several years, and they generally were vexed by I won't say vexed. They were concerned about the Petro-Canada Act and the impact that would have on their ability to do a transaction. So there was an extra complexity there. But when we worked with Petro-Canada, it just seemed like we'd done a fair amount of work with the senior management team there, developed a strong relationship. and they really wanted to start engaging with their board about maximizing value for the shareholders, because Petro-Canada is a great example of a company that was trading below its intrinsic value.
Right.
The stock hadn't been a strong performer, and they were actually starting to come under some pressure
Right.
from some activist shareholders that were unhappy with the stock's performance. And so as the company started to come under increasing pressure to unlock that value, we started to work with them around determining who would be the best potential partners for Petro-Canada. It is a very large company. In the end, it's a $22 or $23 billion transaction. So there aren't a very large number of companies out there that are of a size that can combine with Petro-Canada. And we also had some other issues because it was Canada's energy company. It was actually, because it was under the Petro-Canada Act, we had some extra considerations around foreign buyers and what have you as well. But we spent a lot of time with the board figuring out what the intrinsic value of Petro-Canada was, figuring out how wide that gap was between the value trading in the marketplace and the intrinsic value of the shares. And then we did a lot of work around potential partners, and what we really concluded was that rather than auctioning the company off to the highest bidder and trying to look for a cash deal, really what we wanted to find for the company was more of a partner to really help the company compete globally, because while Petro-Canada and Suncor were both large companies by Canadian standards, by global standards they were still very small. ExxonMobil is a $450 billion enterprise value company. It is much, much larger than Suncor and Petro-Canada were at that time, and even after the combination they were still small by global standards. But there was a recognition that to compete in the energy industry globally you needed to be a lot larger, and it was just determined that Suncor was really the best partner, most synergistic partner with Petro-Canada. And so our role as the advisory team was to act as a buffer between the Petro-Canada board and Suncor. And so talked a lot about value, negotiated value between the companies, and then once a deal was struck and they were ready to announce, we had to be ready for the board with a fairness opinion. And so we did a whole lot of very sharp pencil valuation work prior to the announcement of the deal, and presented our fairness opinion to the board prior to the announcement. And it was also our judgment that in 2009, given that the financial crisis was really in full swing and the Dow had reached a 10-year low or whatever it was in March of 2009, it was within a few months of that we announced the Petro-Canada Suncor deal, and it was our assessment that was really the best time to announce a merger of equals while minimizing the chance of an unsolicited interloper. So there was a lot of judgment that went into the timing to start seeing the line around that transaction, and so I was heavily involved in that entire process.
Okay.
From start to finish.
Very interesting.